Very good morning. You're watching the India market open, and what a morning it's going to be. So much to digest. You know, the things that can happen in 48 hours. The attack or retaliatory attack from Iran was widely expected, but to this extent, 300 ballistic missiles and various kinds of missiles raining down. And then the fact that 99% of them
were thwarted. And there were no fatalities. And now, just in the last 12 odd hours, you have the world trying to calm things down. Just to quote the UN Secretary General Guterres, he says the world cannot afford another war. And I hope better sense prevails. Yeah.
But that's the backdrop this morning. That's the big story, isn't it?
Yeah, Tamanna, and it's the start of a very busy week, even though it's a truncated one for India, because geopolitical tensions, while cooled off, but the overhang certainly remains. India elections get underway end of the week, and you will be busier than ever before. Maybe Vodafone FPO sucks out over $2 billion worth of liquidity from the markets as well, and it's a busy results week for us as well. Tech, post TCS, Infi, HCL Tech, Wipro, there is HDFC Bank. So it's a really busy week that we have on our hands.
Yeah, and an exciting morning to unpack. Absolutely. Yes. The BJP manifesto was out.
Yes.
And considering that they're widely expected to come back to power, what they plan to do in a possible third term becomes very, very important. What sectors are in focus, what stocks are in focus. There's a Phillips Capital note out, and we'll include that as well. I have my top 10 takeaways. So all of that coming up. Just before we go to Jeff Dennis, who's standing by to give us a sense of how this whole Middle East crisis will play out, I want to quickly take you through what the whole global news flow is in the scenario over the last 48 hours, as we said. And we'll start by telling you how U.S. markets were responding. They were negative even before the Iran attack came in. The Dow futures, and I just want to pull up the Dow futures, though did recover to some extent. So you're seeing the Dow futures in the green, but the Dow, Nasdaq, S&P 500 were all in the negative over inflation concerns. There is now talk of a rate cut moving to calendar year 25. So even that conversation has begun. So as that reality sinks in, the US markets, of course, were negative. Bonds also inched up. They have inched up about 25-30 basis points odd to about 4.53. But no major panic. Even in a crude, you did see the Brent move up and then slipped down again back to about $90 per barrel. And there's a couple of factors of that. One of them, the White House making it very clear it's not going to participate in any retaliatory attacks that Israel mounts. So while everyone's standing, the G7 is standing by Israel, the entire commentary and the thought is that don't take this any further. Let's try and leave it at it. Even Iran has come out and said that it's not going to continue and its set of attacks is completely done. Just want to quickly pull up how Asia has opened before we get to Jeff and more of that deep dive commentary. And Asia is mixed, actually. Shanghai not doing too badly at all. So we'll wait and see. Our implied open, of course, down in the red.
No, just one thing. Dow futures are in the green, by the way. So
yeah,
that's actually
I mentioned
good news.
that.
Oh, I'm sorry.
I did.
Okay.
Yeah. I mentioned that. So you're seeing that sort of, even gold did pull back after that initial spike. So yes, maybe cooler heads to prevail. Jeff, good morning from where we are sitting, and great to have you on the show as always. Do you think that that's being overly optimistic, the hope that cooler heads will prevail?
Well, yes, I think so, at least at the moment. I'm a little surprised, as I think you are as well, but I think there have been two key developments. First of all, although unfortunately Iran decided to bombard Israel with rockets and drones, etc., most of those were intercepted by defensive weapons, basically. There's been very little damage as far as one can tell in Israel. And therefore, the need for an immediate response from Israel is perhaps less than we feared when we realized that Iran may attack. And secondly, much like is the case with Ukraine and the war there between Russia and Ukraine, the US is making it pretty clear it does not want to get involved in any attack that Israel may be planning on Iran, just like the US and NATO generally doesn't want to get directly involved in the war in Ukraine. And so I think where we are now is back to, is there a point in the future that Israel may decide to attack Iran's nuclear facilities? And that's been on the table for many, many, many months. And it does look as if this particular situation, it may be cooling off. But of course, it's too early to be completely sure about that.
Jeff, good morning. Niraj here, and good evening to you. And of course, we love having you on all things important. So just wondering, Jeff, do you think risk assets look at the dial down tones and take heart from it? Or do you think this remains a key overhang for the near term?
I think it is a key overhang. I mean, I've always had the view that most geopolitical events that we've seen in the last 30 years, and I've been following markets closely for 40 years now, most of them tend to have a short-term impact only. We see difficult events, nasty events, and then suddenly they may seem to sort of go away. This one certainly has the potential, maybe had the potential to last a little bit longer. As things stand now, this may also be something that settles down, at least until we know what Israel's intentions are, if any, in terms of attacking Iran. But right now, the inability of Iran to get these drones and missiles through, and the US saying they don't want to get involved, I think gives us some hope here that we may get back to thinking about fundamentals with respect to markets. So I'm quite hopeful this thing may begin to de-escalate a little bit. But, I'm not a geopolitical expert, and that's a very tough call at this point. But I'm way more hopeful than I was on Friday.
That stitches up the slightly positive view as well. Okay, Jeff Dennis, thank you so much for staying up till late and just giving us this thing. I mean, I think that's where we park it at, because simply, as Jeff Dennis put, it's very difficult to predict that, but he's a lot more hopeful than he was on Friday. Thanks so much, Jeff, for taking the time out and being with us today. That's Jeffrey Dennis, tracked emerging markets very, very closely, a bit more hopeful, as all of us are. And as Tamanna mentioned in their opening lines as well, the Dow futures in the green give a slight indication of what the world market's not being as pensive. Oil gives that indication as well. We'll talk about oil as well, Tamanna, but just thought we'll bring in the India context here and just get the trade set out of the way, because last week was a week which was contained, right? We had most indices being plus minus 1%. So the geopolitical impact contained for now, yes, remains an overhang. Hopefully doesn't do too much damage than what the implied Nifty is suggesting, which is about 150 odd points, maybe not more than that. But one would suspect that it will largely be a range-bound move with a mild downward bias. But I do think that the outflows may dip today. I mean, we saw an unnaturally large number in Friday's session, over 8,000 crores. Very likely that may not really stay up.
In fact, let's pull up that figure, because remember, on Friday, the whole story was, what is this Mauritius tax treaty impact going to be for FPIs? And later that evening, there was not a clarification, but a sort of commentary from the CBDT and from the government saying that none of this has been notified yet. Now, does that really ease fears? I'm not sure, but 8,000 crores was the outflow from FIIs. More than it usually is, significantly large number, balanced to some extent by DII buys as well. So that's what the Friday story was. Just to round up, the whole geopolitical piece, Niraj, this is one of those things where you can't really say it's over and done with either.
Yeah,
just for now, it seems that maybe the world is not interested in having two wars on at the same time, because Ukraine-Russia is not even done yet. But the focus, I think, domestically is also going to be on result season.
Yeah, so just before we get to that, and which is why I think contained for now, but remains an overhang, largely inbound mood, downward bias, outflows though thankfully may come off today. But from amongst pockets that you see, metals are seeing some institutional buying. You speak to dealers in various dealing rooms, and they are saying that large clients are coming out and buying into metal stocks. So it's not just what's happening via small trade. There is large institutional buying happening in metals. Look at aluminum, by the way, up 6 or 7% overnight. You will definitely see a Hindalco, Nalco, maybe a Vedanta being very active in today's session as well. So metals remains a pocket to watch out for. chemical stocks are starting to see a breakout. I attended the Singularity Conference, which is a Madhukela initiative Thursday and Friday. Every large investor out there was talking about how they are trying to see where is it that they can buy into chemical names now, because they believe that that down cycle seems to be over. So watch out for chemicals in particular as well. At some point of time in the day today, our colleague Varsha will do a very nice deep dive on chemicals. So those two remains a key. And something up Tamanna's alley entirely, the election process getting underway, manifesto-related stocks today, certainly an eye out for, and the results for this week as well, certainly an eye out for.
Yeah, so polling starts from 19th, so end of this week, but the BJP manifesto was the big trigger. Just to, though, take you through stocks that could be really active today, and TCS, of course, is first on the list. The numbers were out right after market close on Friday, and I know, Niraj, you've spoken with the management. We'll have that bit as well. But just a quick take. So the revenue growth was lower than expected. Margins were decent, and that's really showing the efficiency that TCS brings in. So a mixed bag there. I think may have a positive bump up right at the start of trade. I'm not sure if it will persist, because look at things like this, and I found this startling. The net headcount this year for TCS is in the negative for the first time in nearly 2 decades, in 19 years to be precise. They are saying that they're going to be hiring more and they will increase salaries, etc. But that one sort of data point doesn't speak to too much confidence. And if you listen to the management commentary as well, they do, of course, say that they think growth has bottomed out in your North America BFSI segments. But when will you see a recovery? There doesn't seem to be any clarity there. So on a TCS, I think you might see a bit of a positive up move, and then maybe that will peter out. I don't know if you want to come in on TCS. You spoke to the management. You've tracked that number quite closely as well.
Yeah, I mean, I just thought the management commentary, and people will hear this, did not indicate near-term green shoots. In fact, the conversation around elections came about as well. And would there be uncertainty in client spending until the election result is out? So that is way back till November, right? So that was one. Somehow didn't inspire a great near-term green shoots. The margin confidence was evident, Tamanna. You mentioned about headcount coming off, etc. All of that, and subcontracting costs being handled well. So the margin confidence was very, very evident. But growth confidence somehow lacking. And would the street want to see growth as opposed to margin performance as the trigger? That remains the question. So somehow difficult to make a case for long IT currently, at least based on the commentary.
I think currently, relatively, if you grade them on a bell curve, and if Gen AI is the next bit, the kind of push that they have of training, they're saying inquiry pipeline is good. Yeah. So then among the pack, maybe TCS is best placed. But we're, of course, going to have a more detailed conversation on that as well. Just the other lot, since we've been speaking about the Middle East crisis, and this list I found interesting of if there is an impact, then what impact in which spaces. So I'll pull that up. The crude price impact continues to be the big one, right? So if I look at the crude price impact, then you have an RIL, ONGC, HPCL, BPCL, and IOC, or an Oil India in that space, which could see some impact, positive or negative, depending on upstream and downstream. The defense demand play is also very much there, and you should keep an eye out on that. A Bharat Forge, a Bharat Electronics, a BEL, and L&T, because if you're going to be looking at a greater demand for defense and more collaborations, India is not just on the fringes right now. There is a whole supply chain there. So these could have some impact. In terms of revenue exposure, I thought Adani Ports is one to look out for, because the Haifa port, that they run is in Israel. Will there be an impact there? Jain Irrigation was the other one. They have a subsidiary in Israel, so you might see some kind of movement over there today because of their Israeli subsidiary. So this one set. And the other story that I found interesting, and there is a note out this morning also that there could be some impact. Of course, we'll get to more individual movement-related stocks. But the Commerce Ministry has now told e-commerce websites that they can no longer say a Bonvita or a Horlicks is a health drink. They cannot be specified under the health drink category. They have to be called mixes or some such. Would you see an impact on an HUL today, which makes a Boost and a Horlicks because of the reclassification? What about the FMCG plays, ITC, Colgate-Palmolive, or Nestle? A lot of their products, push to the healthy space. And anyway, I found that an interesting story because I think we've grown up understanding that this is the secret to our energy. These are really
is the
healthy.
Secret of Couple Days energy for sure, and Sachin's energy.
These are healthy drinks, and force the kids to have this because it'll make them healthy, and that whole thing changes. And I also found this interesting because the guy who started it all, the influencer, someone Revat Himansingka, we spoke to, and what a big change that can make.
Yes, most certainly. Okay, so watch out for the FMCG stocks as well. But a bunch of other stocks to keep an eye out for before we get to Vanna Hari. She's waiting by. So watch out for Indus Towers on the Vodafone fundraise. So Citi has a note on Indus Towers. They have a buy with the target price raised to 390 from 320. So watch out for Indus Towers in the session today, 328 currently. They say they've opened a positive catalyst watch. They're saying the improved visibility on Vodafone succeeding in its fundraised effort is the key reason. And they upgrade their FY 25 and 26 earnings by 5% and 12% on higher tenancy forecasts. So watch out for this one. Watch out for Anand Rathi Wealth. Revenues up nearly 30%, PAT up nearly 30%. Yes, margins were down a little bit, but the buyback also comes into play at 44.50 or thereabouts. The pricing, small buyback, but nevertheless. So all of that in focus. Keep an eye out on Anand Rathi Wealth, and keep an eye out on Granules and Sun Pharma. Now, Granules, US FDA has inspected the Andhra Pradesh facility between April 8th and 12th and ended with 0 observations. This should be construed net positive. Maybe Granules react, so you should know why Granules could be reacting. And, viewers would remember that Sun Pharma was the top loser in Friday's session. Now, because of a US FDA action on one of its plant, HSBC says that they are retaining the buy with a target price of 1790. Why? Because while there is this overhang of US FDA, so they expect US generic sales to anyways remain range bound on this FDA issues and low visibility of launches. But the bigger trigger for Sun Pharma is that specialty sales are key for earnings growth, which are offsetting the challenges in the US generics. And they expect global specialty sales at 19% of total revenue by FY 26 versus 16%. So global specialty is where the focus, according to HSBC, is on Sun Pharma. So do keep a keen eye out for that as well. There's also Morgan Stanley on X side. They've raised the target price to 485. So that's also good company in focus. But before we get to Vanna, anything else, Tamanna?
Yeah, just a couple. Varun Beverages, I thought one to look out for. They've started commercial production of their carbonated soft drink and energy drinks at UP facility. There was a bit of stock impact when this was first announced, but this has now begun. And remember, Varun Beverages is also in our list of coolant stocks. So in a hot summer, the stocks that may be impacted positively, and this is one of them. Emphasis, I thought this was interesting, and our colleagues are figuring out what the impact is for the company, but the announcement on the face of it, they have a pact with AWS to launch a Gen AI foundry for financial services. It would be great to actually speak to the team and to the management and figure out how they're going to use generative AI for financial services and what are they going to do with AWS on this. Just Sterlite Tech, another one, they've approved an allotment of 8.9 crore shares to buyers at an issue price of 113 per share, lower than what the floor price was set. So I'd watch out for that as well.
Okay. Let's go across to Vanna Hari. She's founder and CEO at Vanna Insights, joins us on the show for crude update. Vanna, what do you think is your base case now that you've seen what's happened on geopolitics in the last 24 hours?
Good morning, Niraj. So it seems a bit counterintuitive at first blush, but this attack has actually de-escalated tensions between Iran and Israel considerably after the ramp up that we saw following the April 1 attack on Iran's consulate in Damascus. So why is it actually having the opposite effect? We see crude prices pulling back this morning. Is that you really have to look at the nature of the attack. It appears to have been carefully choreographed, telegraphed. There was plenty of advance notice and even details about the planned attack that Iran gave to the US and US allies, as a result of which, the 300 something drones and missiles that were fired had absolutely no damage whatsoever on Israel. So what it amounts to is show of strength from Iran, which Iran wanted. It had promised retaliation with no damage whatsoever on Israel. So for the time being, you're going to see, I expect, a continued pullback in the risk premium. I would say nearly $3 per barrel that had become injected into crude after April 1.
Okay. Having said that, we haven't seen a flare up in crude thus far. I hear you say that you expect this reduction in premium. But if there were to be no further geopolitical issues between Iran and Israel, at least, I know the other two wars are on, but if there are no further issues between Iran and Israel, do you expect that 90 for Brent is circa the level that it could stay, or do you expect that over the course of the next 1 month, supply cuts, other geopolitics not coming into play, that crude could make a beeline to 100 as well?
No, 100 is not my base case. It wasn't even before the past weekend. But Niraj, excellent question. So what happens next to crude really is contingent, I would say, on two main factors. Of course, the Gaza war premium and the Ukraine war premium, in that order. See, with regards to the Gaza war, it has been festering for more than 6 months. The ceasefire and hostage deal negotiations, which got yet another impetus the previous weekend, and had the talks had been going on in Cairo through last week. The US and Qatar and Egypt have renewed the push to try and bridge that gap between Israel and Hamas. A big question mark still hangs on that. And as long as the Gaza war is festering, and we still don't know what Israel is going to do with its planned attack on Rafah, which could again flare up the tensions with regard to Gaza all over again.
Right.
So it's difficult to see. It's really hard to see crude to pull back any further substantially. And of course, Ukraine is also all bubbling away again,
right,
with attacks and counterattacks between Ukraine and Russia. So hard to see crude slipping too much from the current levels.
Okay, 100 not the base case, but hard to see it slipping as well. Vandana, thank you so much for taking the time out and being with us today. Really appreciate your time. All right, that's the word on crude as well. Now, the other big story that the street is watching out for is BJP's manifesto. What are the key takeaways, and is there a stock impact as well? Let's get across to Tamanna to talk about all of that.
All right, we went through the entire manifesto and have sifted out the top 10 takeaways, also on the basis of more than just broad blue sky promises, things which will have actual impact monetarily. So, for example, the free ration scheme will now be extended for another 5 years. This is 80 crore plus Indians who get this. Remember, Prime Minister had first mentioned this during the Chhattisgarh rallies last year, but the cost is about 2 lakh crores per year, and that will now be extended. I found this interesting. Senior citizens of over 70 years will be included in the free health insurance scheme, and this is no matter what income class they are from. Could be positive for some insurance plays as well. Expansion of the free housing scheme is important, and at the end of this piece I will tell you what stocks this will help with, but that's a big scheme which will go forward. Free electricity to poor households. So they are going for zero electric bill, but not with a government subsidy, but through the rooftop solar scheme, and this is key as well. They've also said that they want to create appliances in households that can work on solar energy. This is an opportunity actually for Indian manufacturers. The government itself will be investing in expanding the EV charging network, and this becomes key because right now it's largely private players who are doing this. Mudra loan limit has been doubled to 20 lakh rupees, positive for SMEs. The bullet train network will be explored further in the north, south and east corridor. They're expanding metro networks, 5,000 kilometers additional rail tracks per year as well. In terms of political kind of ideas, implementing uniform civil code becomes a priority. They've said this before. If they come back to power with enough numbers, this will possibly happen, and making one nation, one election a reality as well. Now, what is the stock impact that you can look at? And I'll just quickly pull that up. There's a Phillips Capital view today. They expect the economy to be at $6.7 trillion and the Nifty at 40,000 by 2030. That's the first line that sort of caught my eye. But if I look at how some of these schemes could translate, so the housing push push could be positive for a Hutco, major steel players, NBFCs and cement makers like Ultratech and Ambuja. So watch out for Hutco today as well. In terms of other schemes, the railway push will help steel players. Those names on your screen: JTL, Hitech, Surya, APL, Apollos. Of course, your other rail plays also continue in that nod. The EV push helps at Tata Motors. In terms of the auto anch players, Motherson and a Sona BLW also come into play. And then the e-bus service, they're going to expand that. I would say an Electra Green Tech really benefits Ashok Leyland, Tata Motors and the JBM Group. Of course, many, many more. It's a big, broad list. And the push for becoming pharmacy of the world helps some of the CDMO plays as well. Ami Organic, Suvain, Divi's and Syngene. Just, so this is some of the stock impact you could see, but I think more of it is going to be sentimentally that is there a clear enough vision for a possible third term of the Modi government?
Well, trust Tamanna to put that into perspective. And just one quick word just before we got across to TCS, Electra Green Tech could actually be in the eye of a storm today because of what has happened to its parent company Mega Engineering and the ED cases there. So actually in today's session, you might actually see Electra being a stock that gets that kind of sees a bit of a corrective move. So keep that in mind. Okay, let's shift focus to earnings. We had a chance to catch up with K. Krithivasan, MD and CEO at TCS, talking about their earnings and outlook for the company going forward as well. Now, amongst everything else that TCS spoke to us, the key questions to them were around whether growth is coming back and is there visibility there, part one. And part two, has Indian IT been able to make a dent on AI, Gen AI, not from a perspective of just getting numbers going, but whether they have the capability? Listen in.
We don't want to hazard a guess at this time. There is a lot of volatilities. As we keep saying, on one hand, there's a lot of new technology coming in. Our customers do want to invest in those technologies, use them for transformative purposes. At the same time, no one understands the economics, where it is going, and they also want to be ready for a rainy day. So that is making them also pull back on some of the committed expenses, previously committed expenses or investments. So these two things are at play. And there are instances where they also take very, very short-term decisions, right? That's the reason that we are not wanting to call out anything on a immediate term. We've been saying, looking at you talked about the whole year, like whole year, I think we had a strong order book win of upwards of 40 billion. So looking at the sustained order book win and customer conversations, we believe medium to long term, we are quite optimistic and positive. And we kept saying that FY25 would be better than FY24. But difficult to predict on the short term. I don't think it's meaningful.
Can imagine. It's difficult to sit in the chair that you are sitting on for sure. But in the current circumstance. But for the quarter, I mean, the revenue, I wouldn't call it a miss, but for lack of a better argument, let's call it a miss relative to what was estimated and the Bloomberg estimates. Is that because of these reasons that you cited, the macro being what it is and client decision being slow?
Yeah, like when we started the quarter, we were expecting another 50 to 70, 100 basis point more on the revenue side. That's primarily coming from the major markets. We were expecting more growth to come from North America and Europe, which did not happen. But we are able to compensate quite a bit by focusing more on the regional markets as much as we can. So you could see that our diversification playing it off. But that's primarily the reason. Like in US, there are enough uncertainties. Like elections are coming up, people don't know which way the elections would go and what would be the policy changes because of the elections. That's also causing an issue.
So when I was looking at macro indicators in the last 1 month, of course, independent of whether rate cuts happen or no, there is some bit of PMI uptick coming in, and one would want to believe that might lead clients to be more confident. But I hear you say that in the US, the election is also as big a factor. What's the sense? You may not be right at the end of it because no one knows, as you said, but what's the sense? Could this economic tailwinds or green shoots result in better spends, or would NA be impacted by these uncertainty around elections until November?
So, see, if you disregard the election for a moment, okay, like you said, and we also been seeing the fundamentals have been good for not this quarter, like for a couple of quarters, and I feel some people are waiting for a recession to happen, which is not happening. But everyone in the back of the mind think that consumer spending should reduce over a period of time, and which is causing that worry. And but like you said, even in the current quarter, if you look at all the macro indicators, they are all looking positive. So my view is, disregarding the election, there should be a uptick in the medium term. But elections, and the outcome of that could go anywhere, right?
Okay. So your optimism around FY25 results from not what happens in North America or Europe, but the other geographies, because you have said that FY25 will be better.
I know, our optimism comes primarily from our strong order book. Our customers have been willing to sign large deals. Okay, there would be yes, there are pullbacks, there are some old programs that get paused or cancelled, but it's fine. But we believe that considering the size of the order book, okay, it should eventually drive our growth. Maybe not this quarter, but sooner than later that growth should come in. And based on the conversations we've been having, see, for a large part, though we talk a lot about macroeconomics on why customers are spending, we believe that whether it's an economy that's up or down, there are enough opportunities for organizations. Like if the customers are focused on conserving or cash, we have to go to them with solutions around cost optimization. And if they are interested in transformation, we'll go to them with more transformation opportunities. So by and large, we have a strong suite of portfolio of offering with which we'll go to the customer. And my optimism comes primarily from our TCV. I don't want to use the macro as an excuse for growth or lack of it.
Okay, fair call. May I play the devil's advocate though, sir? And the question is this, that your TCV, yes, has done remarkably well. I mean, these deals that you won are spectacular, but it's not that was too much under question even in the last 12 months, right? You had an order book which was decent, and yet the numbers relative to what history is shown, recent history is shown, were slightly below. So what is to say that despite this TCV, the growth will be better than FY24?
Yeah. So two things, right? What we see is some of the old programs have been reprioritized. I believe last 4 quarters, as much of reprioritization has happened, and what is still being executed. I'm assuming these are all the programs that really mark the threshold, and customers want to continue.
Okay.
And so over a period of time, if some programs are not that have to be canned, I'm assuming most of them would have been canned by now. The second factor is how much of the conversion we are seeing from the recently won order book. The conversion from the recently won order book is quite healthy. It is not much less compared to previous years. We are seeing the recently won projects, most of them are yielding revenue based on the same historical level. So these two factors coupled with, we believe the growth should return. The drag from the old programs getting cancelled should reduce.
All right, so you can watch that full conversation, of course, on all our socials, our YouTube, and ahead in the day as well on NDTV Profit. Meanwhile, quick look at the implied open before I get to Agam, who's standing by to break down the F&O cues, and take a look at how we're likely to open today, which is with a downtick. Not surprising, considering all the geopolitical tensions that have been brewing. Yeah. Are you seeing those cues play out, Agam?
To a certain extent, Tamanna, we did see the markets take a step back because perhaps in some anticipation of weakness coming in. We already had started getting some cues around volatility across the globe, and that's possibly the reason why we did see in the Nifty, in fact, come off by around 1%, and longs unwinding seen as well. For the Bank Nifty too, the picture wasn't very different. We saw a 0.9% decline in the underlying with another near 9% decline in the futures open interest. When it comes to the options market, naturally, since the Nifty came off, we also saw a lot more writing around higher level calls. And to talk about the overall distribution picture when it comes to your options market, at the moment, we still do have maximum open interest lying with 22,700. And of course, on the lower end, it's now a widened range coming out around 22,200 where we have maximum open interest in puts. But moving on to talk about how things panned out for the stocks. Well, we did see Metropolis and Syngene look at longs. Maruti Suzuki and Sun Pharma, on the other hand, looking at shorts. And in terms of stocks, we saw unwinding. We saw short covering for Exide, Crompton and Hindustan Copper, with Dalmia Bharat and Vodafone Idea looking at long unwinding. But let's see what we do of these cues globally and how we can take them forward. Well, we are in conversation with Ajit Rambia of Ajira Ventures, who's joining us on the show. Ajit, good morning. Thank you so much for joining in. Given the kind of expectation of increase in volatility, what is your take when it comes to the Nifty and the Bank Nifty? Where are we headed and how would you trade them?
Yeah, good morning, Adam. Thanks for having me on the show. After a long and strong bull run, we feel the market is out for a breather. There's a growing anticipation of a market correction, signaling a shift towards a bearish trend. Even the global market cues and the geopolitical situations are reinforcing this sentiment. Usually, after such bearish movements are short and swift. The best thing about derivatives is we can form bearish strategies with minimum risk and take full advantage of these bearish movements. Right. Furthermore, with the general elections scheduled in May, we expect the markets to be very volatile. Speaking about the indices, the resistance of Nifty is at 22,650 levels, and Bank Nifty, the resistance is at around 48,800 levels, above which one can cover their shorts. Okay. All right. So then let's talk about stock ideas at the moment. Ajit, I believe the first one on your radar is Bandhan Bank. We are bearish on this counter. It has been consistently showing weakness and is a perfect short opportunity. So we suggest a bear put spread for this counter, where we buy one April put of 180 at 3.85 and sell one April put of 165 at 1 rupee. So the investment for this strategy is just 2 rupees 85 paise to capture a possible gain of 15 rupees. All right. So, well, a bear put spread coming in as far as Bandhan Bank on the expectation that the bank could potentially see more weakness coming in. And it's a fairly straightforward strategy, of course, not unlike what you would deploy in several other cases. But Ajit, the other one on your radar is Maruti Suzuki, and that's where also we saw a little bit of weakness seep in Friday's session. What's the view here? Yeah, so we are bearish on Maruti too. So this counter has broken its crucial support level, and we can expect it to go down further. The current market price is around 12,225 in the cash market. We can place our stop loss at around 12,600 and a target of around 11,900. Here we initiate a bearish strategy where we sell one April future for 12,315, which is the latest price. Buy one April 12,600 call at 110 rupees, which is our stop loss, and sell one April 11,900 put at rupees 90, which is our target price. So we cover our 12,600 cost with 11,900 put. Okay, so another very interesting strategy here, but of course this also involves a future, going short on a future, but you also have options involved as far as the call and the puts are concerned. But on the whole, expecting some more weakness as far as Maruti Suzuki is concerned. That's the word coming in from Ajira Ventures. Ajit, on that note, thanking you for joining us and taking us through your views on the markets and giving us those two strategies, bearish strategies on the markets at the moment. And with that, it's back to you, Niraj. Right.
Thanks for that, Agam. So that's, of course, the word on some of the option strategies. But remember, you heard from the TCS management before the break. Now, what to make of the TCS commentary for TCS and for the IT space. Let's get in Moshe Khatri. He's MD of Equity Research, IT Services and Payments at Wedbush Securities. Moshe, good having you. Thanks so much for joining in. Good evening to you. I presume
Good morning.
Yeah, thank you. What did you make of the commentary from TCS? I thought the confidence on margins existed, but the similar thing on growth seemed to be missing.
The commentary on growth is not surprising. So first of all, we knew that the March quarter is going to be muted in terms of revenue growth. A lot of this is a function of the budgets that have not been finalized probably until the end of March. That's probably about a month and a half to 2 months kind of push outs. If you don't have budgets finalized, you don't have funding for new programs. And obviously that impacts, discretionary spending, that impacts a lot of other things. And obviously in their case, it was weak North America and weak financial services in terms of vertical. They did indicate that we should have a better fiscal 25 versus 24, and a lot of the function of the deal flow that will start converting probably in June and obviously into September. And again, it's kind of playing out the way we thought it's going to be playing out.
Yeah, Moshe, good morning. Tamanna here. In terms of how the stock will respond or how investors should look at TCS right now, it's a bit of a mixed bag, isn't it? They've managed to control margins fairly well. They're saying that the worst may be over, but their headcount has decreased. How would you look at it in the short term? Those watching us right now before Indian markets open are possibly wondering what they should do and how they should see a TCS in the next couple of hours and maybe in the next couple of days.
You've really expressed what we hear from both sides of the buy side. There are the skeptics that suggest that the headcount degrowth is an indication that lackluster growth coming up. On the flip side of it, the bulls are saying that ultimately you should start seeing that the deal flow converting, and obviously that means that revenue growth should start inflecting June into September, etc. So I think this is where we are. There's definitely two camps on the street that are looking at this. I'm assuming the stock's reaction may be kind of mixed, maybe a bit weak, and kind of maybe it'll be range bound until we get a better indicator throughout the June quarter whether we are starting to see the conversion kind of improving. In fact, we're going to be hosting an investor visit to India during the week of June 10th. It'll be an interesting week just because before the quiet period, and hopefully we'll get some indications whether this is happening or not. And this inflection point in June is really going to be important because that will determine how the rest of fiscal 25 is going to look like for the space.
In relative terms, Moshe, because when we speak about Indian IT, it's also about how a TCS stacks up against peers. And if I were to apply the filter of being at the forefront of Gen AI and the kind of demands and inquiries from clients coming in on Gen AI, where would TCS stack up? And is that a sort of a condition that you would look at?
Gen AI is very critical for being relevant in the space, and I would say that the top tier India-based companies are doing a really good job in terms of building those capabilities. The software engineering firms that are smaller, the mid caps, are doing a good job in building those capabilities. So I would say that TCS is probably going to be in the top 4 or 5 in terms of getting there. The real question here is whether we're getting to that scale. And whether that kind of moves the needle. I don't think it happens this year. It probably happens maybe 12 to 18 months from now.
Okay. Moshe, the last question really. While quarter being subdued is not a surprise and subdued commentary not a surprise, is there a possibility that global clients for Indian IT services companies or IT services companies in general, particularly on the NA side, might wait for clarity for the elections and then take a call on what to do with the spending, and therefore would the time period between now and November largely get discounted for growth?
So a couple of things. Your comment is probably relevant more towards the discretionary spending part of the business, because again, by default, it is discretionary. We're talking more about the cost takeout part of the business, and this is where these are deals that have been signed 9 to 12 months ago, and they will be converting. They're converting regardless of the outcome of the U.S. elections, just given the fact that these are functions that will help enterprises bring down costs. It's non-discretionary, and again, that's the part that's going to drive growth in our view. Starting in the June quarter. If discretionary comes back, that will be great. That's kind of going to be the extra bonus, if you will. But I don't think at this point there's a lot of dependence on discretionary spending really coming back here.
Moshe, just last question from me. Do the TCS numbers, the management commentary, sort of set the tone from what you're expecting from other peers in the space and Infosys, Wipro? Or what would you be looking out for? And if I were to ask you to rank the three in your order of preference, what would that list look like?
TCS's commentary is not that different from what we heard from Accenture about a month ago.
Yeah.
So it's all kind of in there. It's all in line. I'm assuming we're going to hear very similar commentary from Infosys, from Wipro, from some of the other smaller to mid-cap names in the space. In terms of ranking, as you know, we don't cover TCS, but in our universe, we actually like Accenture, we like Infosys, and we also like some of the smaller cap names in the universe.
All right. Smaller cap names like any of them that you can specify?
EPAM, Globant.
Okay.
These are the two that we kind of like here.
All right. Thank you so much, Moshe. Always a pleasure speaking with you. That's the take on TCS, and it's largely a mixed bag. I think if I were to pull out one headline from all the commentary coming in, some bits good, some bits not so good, bit like a curate's egg. What does Sudeep Shah think? He's joining us today. He's Deputy VP, Head Tech and Derivatives Research at SBI Securities. Sudeep, very good morning to you. Before I come to you on your take on TCS, I think let's talk about the indices, Nifty and Bank Nifty. Considering that your implied open is indicating some weakness, there is geopolitical tension, etc. How do you look at opening trade today?
Yeah, good morning. See, what I'm expecting is that the market would be opening as it is on a weaker footing, closer to 22,350, 22,370 zone. But now this zone is a very crucial support zone. Now 22,250 to 22,300 zone is the make or break zone from a Nifty standpoint, as this is the 50% Fibonacci retracement level of the entire prior rally from 21,700 to 22,775. So this zone of between say 100 point zone of 22,200 to 22,300 will be very, very crucial from the market standpoint from the next couple of days perspective, not only post opening today, but the next couple of days, this zone will be extremely crucial. And given the way the crude prices have moved to $90 a barrel, dollar index almost touching 106, US 10-year bond yields also moving beyond 4.5%. I feel the markets would consolidate in this range between 22,200 and 22,600, 700 on the upside. And now it would be more, the bullishness would come once Nifty surpasses 22,700, 22,750 on the upside. So overall, I feel the markets would consolidate between this 400, 500 point zone of 22,200 to 22,700, and a lot of results which are due this week of top companies would, I guess, determine the way the markets would now keep moving on the upside or on the downside.
Okay. Sudeep, with that market view, what are the stocks that you're recommending this morning?
Yeah, so the first stock that I feel that could do well is Tata Power. Now, if you see the chart of Tata Power from a daily standpoint, the stock has broken out above 405, 407. Post consolidating for a good period of 1.5 months, and now what we are seeing, all these power stocks are gaining momentum in the last few sessions. So I feel overall Tata Power, if you see the last 4 weekly charts candles also, they are showing a higher top, higher bottom formation, and I feel from the current levels Tata Power could make a move up to 460, 465, and can be bought with 423 as a stop loss on the downside. The second stock that I like is Cummins India. Now, in the last several weeks, we have seen these capital good names such as Siemens, ABB, Cummins. They have witnessed better relative strength compared to the Nifty 500 as well as the Nifty 50. So I feel overall the kind of outperformance that these capital good names are showing, the latest to break out on the upside is Cummins. So in the last few days, if you see Cummins, it has broken out of a consolidation post 6-7 weeks, and I guess from the current levels, it is headed up to 3150, 3180 on the upside, and can be bought with a stop loss of 2980 on the downside.
Okay. Now, the flashes on your screen, Adani Green business update, sale of energy increases in FY24 up by 47%. And, well, some of these are not very easy to dissect the importance, but you can figure out that if the wind portfolio CUF is at 29.4% with an improvement of 420 basis points, that probably is a positive. Just reckon that this update, operational capacity being up 35%, is positive as well. There's a 3 lakh crore market cap stock which has put in such a high growth number. Could be an interesting one to watch out for. Amidst all the stocks that we've spoken about, add this one to the list as well among stocks which could have a bit of a reaction. Standard disclaimer, of course, that the Adani Group owns NDTV and you're watching NDTV Profit. So keep that in mind. But net of that, that just seems to be a very strong update that the company has given.
Sudeep, is this a counter that you track, Adani Green?
We do track this counter, and I feel if you see the charts since October, November 2023, when the stock, it was prior to that period, it was consolidating between 800 and 1,000 rupees. But post that breakout above 1,000 levels, 1,050 levels, we have seen a strong up move in this counter almost till 2020 levels in Feb 2024. The last 1 month, we have seen some decent consolidation also, and this stock has relatively held stronger compared to all the other counters where there was some kind of selling pressure also. So overall, I feel with this kind of updates that we are right now just seeing the flashes on the screen, I feel overall the support zone would be 1830, 1820 on the downside. Until this zone holds, we could see a decent move, a trending move on the upside up to 2020, 2050 levels in the next few sessions.
Sudeep, just wanted a quick take from you on TCS as well. Before we get into other stocks on the radar and some interesting brokerage notes out as well. But TCS, since it's the stock of the morning and at least something that everyone's got their eye on, I was wondering how you see it on the charts.
TCS, I feel overall a strong support zone is being formed around the 100-day moving average, which is closer to 3850, 3870. And if you see the charts of TCS closely, this stock has not fallen much from higher levels, whereas in line with the other IT stocks. So a lot of other IT stocks have fallen more than 5-6% from the higher levels. But if you see TCS, this has relatively outperformed. And even if we put it on a ratio chart, there is a decent bit of outperformance visible in TCS as compared to the Nifty IT index also. So I feel overall this stock could head higher today, and above 4050, 4070, we could see 4150, 4200 levels coming on TCS. And the overall support zone on the downside would be 3860 levels.
All right. So that's the call on a TCS, but a lot more to talk about this morning. And Kanika joins us with a list of stocks to keep an eye on in trade today. Yes, Kanika?
Right, Tamanna. So first we have Power Grid Corporation of India, where the company is considering to raise up to rupees 12,000 crores via non-convertible debentures on private placement basis. Now, the meeting of Committee of Directors for Bonds is to happen on 17 April 2024, and it has approved proposal to issue bonds of rupees 1,200 crore on March 4. Next up, we have Ami Organics, which has approved raising of funds up to rupees 500 crore through QIP, and it has an outlook for FY24's revenue growth of about 15 to 18% and for FY25 at 17 to 22%. Coming to margins, it has the guidance of FY24 at 18% and FY25 at 23%. Next, we have ISMT, which has received two orders of rupees 343.7 crores from ONDC, and it has received order for supply of casing pipes, and this order is to be executed by Feb 2025. And finally, we have Rail Vikas Nigam, which has received an LOA of rupees 95 crore, and it has received the order of EPC for new line project of Araria, and the contract is to be executed within 240 days.
Okay. Well, watch out for some of these stocks for sure. Just a checklist, by the way, of some of the stocks that could be important. We've spoken about Adani Green. We've spoken about Indus Towers could be in focus as well. Very, very interesting developments on Vodafone, and as a result of which that stock also comes in focus. All upstream and aluminum in particular related stocks, the likes of Nalco, Hindalco, even Vedanta maybe, could all be in focus. Mahantesh Sabarad, independent market expert with us on the show as well. Mahantesh, great having you. Thanks for joining in. There seems to be some bit of an institutional flow, Mahantesh, towards metal names. Speak to dealing rooms and they talk about how Insti clients are getting into metal stocks. We've seen some evidence of that in the movements thus far. Aluminum is up 6-7% overnight, the biggest move since 1987, I'm told. Are you constructive on ferrous or non-ferrous metals?
So when you have global PMI indices going up, including those in India, you generally find the metal stocks doing better because there would be that would indicate that manufacturing activity is on an up move, and therefore consumption of metals could be relatively high. And then you have now a situation where prices are going up simply because of certain geopolitical tensions, war-like situations, and general uncertainty related to future supplies. So in such a situation, you will see both the consumption going up as well as prices going up, aiding, therefore, the valuation outlook in the near term for many of the metal stocks. But then we have to be careful because India, while Indian metal stocks are exposed to global volatility, they are, I would say, still well protected from any either supply disruptions or price manipulations or prices going too high or any such situation. So we have to be a little careful when it comes to the metal stocks valuations in India. Fortunately, many of the companies in India are going through a capex phase. That means they are enhancing capacities. That's generally considered good. And therefore, valuation should look better. But then if you have a situation where stocks run up 30-40% in 1-3 months, then you have to be very cautious in terms of making any fresh entry year in onwards.
Okay, Mahantesh, thanks for the thought. So clearly some constructive views by multiple people, I must say, on metals by and large. And Mahantesh's point is well taken. When global PMIs are doing what they are doing, it's a space that you should at least watch, even if you don't want to buy and if you're not a high-risk trader/investor. Take a quick break, though. We need to slip into one. We'll be back in just moments from now with the pre-open session and some more conversation on some of the key stocks.
Welcome back. You're watching India Market Open. Just a couple of minutes for the pre-open rates to hit, actually less than under a minute. Now, the question is that will you see metals dominating today? Are geopolitical factors going to weigh heavy, or are they going to be shrugged off? While we're speaking about all of these broad ideas, Mahantesh Sabarat, do join us on a specific sort of ask. And here, let's focus on the IT pack. TCS numbers, do you see any kind of a positive reaction on open, considering that margins were better than expected?
Yeah, I think the key takeaway from TCS results was that the margin was very good. Even from a quarter-on-quarter growth, if I'm right, if I did my calculations right, the quarter four's exit rate was 1.1% quarter-on-quarter growth for TCS. So having said that, let's go back 2 years ago, and what's been happening now for the IT companies is that they are struggling with ramp-ups from the clients. So with the result that they are very cautious on the headcount side. You would notice in their results, one of the reasons for the margins being up is simply because they are outsourcing to consultant. The consultant-related costs has shrunk massively, which means that they are depending a lot on their own employees in terms of deliveries. And within their own employees, there's not much growth in terms of headcount. So that tells us that they don't seem to be at this juncture very gung-ho about the growth ahead. So 1% quarter-on-quarter growth, if you were to factor in ahead, you will find that a TCS like IT company in the year ahead will possibly grow the low single digits to perhaps mid, 5, somewhere around 7-8% thereabouts. That may, and with an exit EBIT which is already at a high, tells you that there's not much scope available for an EPS growth and valuations to rise henceforth. TCS is known to reward shareholders in terms of dividend payouts and buybacks. I would rather prefer dividend payouts to buyback because not everybody can participate in a buyback wholesomely. That said, I'm not too sure whether TCS will be able to grow sufficiently fast enough for valuations to rise from here in onwards.
All right. First pre-open rates have hit, and take it with a pinch of salt because you can expect a lot of volatility. Having said that, it's quite a bit of a sell-off in the first minute or so. Hindalco is doing okay. Hindalco, the one exception that I would say in this market right now, DRL, Shriram Finance, ONGC, there's a Jefferies note on it which might be seeing some positivity, but otherwise quite a bit of red, whether it's a Bharti Airtel, Tata Motors, Adani Ports, of course with the standard sort of disclaimer that this is just the first few minutes of rates that we are seeing. Mahantesh, do you expect too much of a reaction to what has happened over the last 48 hours in terms of the Middle East crisis, escalation fears, etc.?
It remains to be seen. At least we know that Iran has come out with a statement that says their attacks are over and they expect no escalation. I would reckon that most of the investors would rather be jittery and therefore take the money off the table for the current time and watch what the developments are in the next 1-2 days before really getting either back into the market or get out of it. So it will be a cautious kind of approach. The first approach says lighten your portfolio burden currently and wait and watch.
Okay. Well, in light of that, crude was anticipated to show a big bump up. It hasn't, but it has gotten, maybe just not that reason, but some brokerages are certainly excited about what could happen to upstream oil. Jefferies in particular has initiated coverage on ONGC with a buy rating, a target price of $390, if I'm not wrong, was the current price of $269. Mika has the key points from that note. Good morning, Mihika.
Good morning. So yes, the target price is at 390, which offers a 47% upside to the previous close. Now, Jefferies is constructive on the stock because of the tight crude oil market. Just to note, Brent crude prices are up 18% year to date, and the IEA has upped their oil demand growth for current year of 2024 while lowering the supply estimate. Additionally, the pricing reforms in the gas sector would help the company and be earnings accretive. This is in terms of floor price, the ceiling price, and the $0.25 per MMBTU annual hike that is expected from FY26 on forward. They also said that the net realization per barrel of oil has risen from the $30 during the pre-COVID average to $43 over FY22 and FY23. And in terms of production, there was a 2% annual decline between FY14 to 24, but they expect ONGC's domestic production to return to growth in over FY24 to FY26. Additionally, the KG fields, which has started production, will drive 3 and 6% of crude and gas production CAGR respectively over FY24 and FY26. And the company will also benefit from the special additional excise duty not being applicable to the KG basin production, which helps the company. And they've also built in a 1% growth for OVL, which is currently having some resolutions regarding some Russian assets, and this is without assumptions of a resolution. However, the company does expect to resolve the issues in FY24. And lastly, they see the net cash position of the balance sheet rising. They expect free cash flow to the tune of 71,000 crores over FY24, FY26, and they also expect the company's net debt to equity to fall from 0.32 to 0.16 over FY23 and FY26.
All right, thank you for that, Mihika. So ONGC also likely to see some positive impact as crude prices could get dearer thanks to what's happening in Israel and Iran. Right now, at least we see that geopolitically that might have evened out, but will it continue remains to be seen. We had talked about a set of stocks which could see an impact of the Middle East crisis and ONGC, of course, naturally up on that, but in Oil India, RIL, HPCL, BPCL feeling the pain. I just want to also pull up what's happening with an FACT and some of the fertilizer plays. Now, Israel is a big exporter of potash ash, a key component for fertilizers as well, and you could see some impact there, even as pre-open rates settle this morning. But look at a GSFC, for example, also seeing some pain. Another set that we were looking at in terms of impact of these counters was in Adani Ports. We were looking at a Jain irrigation. Let's see what's happening there this morning. And you're seeing some weakness, at least in pre-open rates. Overall, even as rates are settling, you're looking like you're in for a bumpy start, Niraj. Definitely this morning, isn't it?
Yeah, most certainly. Interesting thing, I mean, we're seeing some specific stocks reacting very, very strongly. Aster DM in particular seems to be the one that could really have a strong start, and of course the metal names. So, I don't think we asked Sudeep about his view on Hindalco and Nalco. Sudeep, did we ask you about that? If not, and even if we have, they are likely to start off about a couple of percentage points higher. Would you initiate a long call on a Hindalco or a Nalco after this start? Okay, I think we've just lost Sudeep, but keep an eye out. Yeah, okay, Sudeep, I think we have you now. Do we have you?
Yeah.
Okay, Sudeep, your view on Hindalco or Nalco?
Yeah, so if you see both these stocks, whether Hindalco or Nalco, let's first discuss about Hindalco now. Hindalco was in an uptrend in the entire 2023. We then saw some bit of correction up to 500 levels from 600. And once again, the stock is at old levels of December 2023, and it will drop a clear breakout. So I feel overall Hindalco can do well. The short term, medium term, as well as the long term charts are indicating a good, decent trending move on the upside. And with the kind of moves that we have seen overnight into all these aluminum names globally also, I feel Hindalco from the current levels can be bought on dips with a 590 stop loss on the downside, and the stock can do 630, 640 on the upside and could buck the global trend now and could be one of the topmost performers in the metal index itself.
Okay. So that's the word on metals. Now, of course, there is one more a key stock to watch out for in the session today, and that could well be Exide, if I'm not wrong. And my colleague Puneet has the details of the Morgan Stanley note on Exide. Puneet, there is a short term and there is a long term that Morgan Stanley is painted for Exide, I believe, in this note. Take us through the key highlights.
Yeah, that's right, Niraj. So Morgan Stanley has come up with a very positive view on Exide with a 22% upside from current levels, with a target price of roughly 485 rupees per share. Now, this report has come on the back of the new contract that the company has got from Hyundai as well as Kia for supplying battery packs going forward for the EV cars in India. Now, do note that they have said that the share price could significantly see an upside from the current levels over the next 10 years. They've also mentioned that the company has underperformed the Nifty index over from 2018 to 2023 by 30%. So going forward, they see a lot more upside for the company. They see that the company has been an early mover and has an advantage which could lead to a favorable outcome in the EV battery packs, while the addressable market for these electric vehicle battery packs is roughly $13 billion as per the brokerage report. Now, they see that this partnership could be a multi-year contract and validates the progress the company has made with investments of over 2,000 crores over the past 2 years. Finally, the current target price is at a 1.4 times price to book versus a 3 times price to book for the global peers. They've also said that during the scale-up phases of the battery plants in EVs, then generally companies globally get a 4 to 6 times price to book multiple. So at 1.4 times is lower compared to the global peers, while they say that Exide could even double from here and implies that the bull case scenario of roughly 88% from the current levels if valued at roughly six times. So a really positive brokerage view coming on Exide, and that's all we have on this particular segment.
Well, watch out for this one, Exide 401. Mantesh, fundamentally, so Puneet, thanks for that, of course. Mantesh, fundamentally, is a battery stock like Exide, or maybe even Amara Rajavar Exide in particular, something that you would look at?
Generally speaking, yes, we would look at a battery stock simply because what happens is that under a situation where you have more EVs coming into the market, you'll have battery requirements going up. Now, the fundamental difference between the current products that these battery makers deliver versus what an EV would require is large. That means the current battery sets are low voltage, low wattage kind of batteries, which essentially take the needs of all the electronic or electrical components on a car currently, but they do not necessarily form the drivetrain. But my guess is as we go forward, many of these battery names are either tying up with global majors for the drivetrain batteries, or are considering having their own products in that range. So generally speaking, I would be a little positive about this, but await the outcomes of what technology absorptions they're doing, what innovations that they're doing, because there could be a considerable capex that may accompany such a growth ahead. So right now, a little, positive and constructive on the battery space. Generally, they have been known to deliver profitable growth, although they are prone to cyclicity. Having said that, they also have a large amount of, replacement market to cater for. So there is profitable growth ahead.
Okay. We'll watch out for that. There is some upticks, of course, in some of the hospital names, Aster DM and Fortis Malar, so watch out for those. They are positive. There is a sharp pullback in Titagarh Rail, for example, today, 7.5% down for that one. And Tamanna was mentioning how some of the power-related names, SJVN, etc., are down today. Interesting cuts there into some of those. Prince Pipes is down about 6% as well. So some of the stocks are taking it on the chin in a big way. I would reckon this has probably got to do with the fact that the market itself is down about 1%. I mean, Nifty is down 0.8, Sensex 1.25. So some bit of unraveling happening there, but substantial losses for select stocks in the session today. Sudeep, very quickly, we have a minute left. Torrent Power, which is starting off way lower today.
Niraj, Torrent Power, if you see the stock which is scheduled to open a bit lower, I feel 1450 zone, 1460 would now act as a stiff resistance on the upside, and on the downside, key support zones are closer to 1230, 1250, where the 50-day moving average is placed, and where in March the 24 there was a breakout about 1230, 1240 zone. So I feel that zone now could get retested, and 1220 to 1250 band would act as a key support.
Okay, Sudeep, we have 30 seconds. Your top call for the day today.
I feel I would go with the same stocks that we have discussed in the morning, Cummins and Tata Power on dips, because the positional setup in them are looking good and way better than all the other stocks where we are seeing deeper cuts. So I guess Cummins would be one of my top picks for the day.
Okay, we'll watch out for these. Gentlemen, stay on. Actually, Mahantesh, we'll let you go on that note. Thank you so much for being with us and giving us your thoughts. But just 9 seconds left for the markets to kickstart. So quickly, in fact, let's mark the open and see how bad it is. Is it contained or does it start unraveling more? It's about 200 points, slightly worse off than what the implied open was suggesting, must say. But 0.8, it's not too dramatically bad. IT is actually doing better than the banks are. Banks are down about 0.75. IT is just 0.28. That's interesting. Metals down about 1%. This is a bit of a surprise. Let's get the quick mention of the mid caps and small caps. 1.5% down for mid caps. Small caps too should be cracking. 2% lower. High beta. Let's get the heat map up. Very lot of red, very little green. In the green are Hindalco, ONGC, no surprise that TCS marginally in the green, but ONGC on the Jeffries note, and the crude price uptick possibility. Hindalco because metals have done so well, but look at the red on the screen. Very similar, eerily similar to the screen that we had in Friday's session. Sun Pharma still corrects, is still the top loser, despite HSBC, for example, saying that doesn't seem to be too bad. BPCL down. Well, oil price upticks would lead to some of these companies down. Metals, interestingly, Tata Steel and the steel companies are down. Coal India is down, which explains why the metal index is looking slightly wobbly in the session today. Tata Motors, Adani Enterprises, Tata Consumer, Kotak Bank, everything is being ripped apart. There are only 3 stocks in the green, and 2 of them are commodity stocks which are gaining from this. Remember, viewers, commodities inch up is usually bad news for equity markets and risk assets per se, and that is what we are starting to see currently. Tamanna, broader markets.
The pain continues, and it's a morning of quite a bit of a pain as well, and you see that in the broader markets as well. Over 1.5% down on the mid-cap index. We'll pull up the small cap as well. And one trend that at least I'm seeing clearly, deeper cut on the small cap than even on the mid-cap. One trend that I'm seeing very clearly in morning trade is your alternate energy plays are also getting hammered quite a bit. So if you pull up say a Torrent Power, an SJVN, a Suzlon, an NHPC, that entire list seems pretty hit. Torrent Power still has recovered in the last couple of minutes, and it's still about 5% down, but even an SJV and a Suzlon. And you can see a couple of factors over here. One, why is alternate energy not looking like a good play, where this geopolitical contest is going on and this conflict is escalating. On the other hand, a lot of these are in focus after the BJP manifesto as well. But nevertheless, maybe a sell-on news kind of a situation. So that entire list, look at an SJV and to a JSW Energy. Hotting today. 2 counters that Niraj also mentioned, Aster DM and Fortis Malar. purely on dividend news. Aster DM has a 118 rupees dividend. They've been generous with their shareholders. Shareholders have rewarded. So because of that large dividend payout, you're seeing that stock one of the few spots of green and, strongly green with a 12% raise. Let's look at what's happening with the Fortis. If we can pull up a Fortis Malar as well. And look at if that has impacted. That's on 20% circuit up. Again, dividend play about 40 rupees. Vodafone is one that doesn't seem too negative this morning. I wouldn't say it's great, but at least it's in the green. After that FPO news getting digested and marquee names which came in right during close on Friday. Fidelity, GQG, marquee names which are showing interest in Vodafone. That's the story that we had on NDTV Profit. Chola Holdings is the other one that you should look at. Now, if you look at the Philips Capital note this morning, Chola Holdings was mentioned a couple of times as really, seeing benefits because of all of these government schemes which will roll out. Not too much benefit for that stock this morning, though. And Suven Pharma is just the other one that I would point out because if you want to be the pharmacy of the world, what happens? That's also down. So maybe a sell-on news definitely being seen on some of these manifesto impact stocks this morning.
Buy the rumor, sell the news. I don't know, Tamanna was saying that. Let's see. But yeah, clearly some downticks there. Just a couple of names that I want to mark. I also seeing downtick. Electra Greentech is now the second worst performer on the Nifty 500 because of the regulatory action against Mega Engineering, I believe. I think it's CBI, which has, I think, done some inspections or something to that effect, as a result of which I think Electra is down about 6%. But actually, if you look at the list of the top 10 losers, it's got to do with everything that will benefit, Tamanna is right, from the manifesto. Very, very clear set of moves that we're seeing there. But
we should actually pull up that list of what the Philips Capital note mentioned. We did a piece this morning.
Let's get that list
we did a piece earlier this morning we put out the top 10 takeaways from the manifesto. There's a Philips Capital note as well. It'll be interesting to see stocks that are on that note, as well as what's happening this morning. The Adani Ports drop that you're seeing, of course, is because of Haifa, possibly to some extent. But HUDCO, so the affordable housing scheme is going to expand. You're seeing HUDCO down today, JSW, Kalyani, all of them down today in, the steel plays as well. NBFCs also looking particularly painful. Just another stock, and this is two big factors playing in the market right now, right? You have Israel and Iran, and you have the BJP manifesto. So let's finish this list first. Ultratech, Ambuja Cement, because of that whole infra affordable housing push, expected to be an upside or a buy, but none of them doing too well this morning. So you're seeing definitely that pain coming in.
Yeah, most certainly. But it's okay. Just before we get in Pratik Agarwal, just a quick opening thought from Sudeep. And Sudeep, we'll have to make this quick. About 6 minutes into open, anything that stands out for you?
Not as such, because the losing stocks are incrementally increasing their losses, but stocks, say the IT stocks are just holding out. So not specifically any stock which is coming up, and I feel we should be a bit cautious going into the first half today. Just see how the small caps and the mid caps are behaving, because that would set the tone for the entire week. And with the kind of cuts that we are seeing across the stocks which are going to be benefited by the manifesto, I feel a lot of these stocks would give us good opportunities in the days to come, because the manifesto is from a 5-year perspective or 3-year perspective, from a medium-term perspective. It's just not for 1 day or 2 days. So these stocks would give us good opportunities. These dips, I guess,
I agree on that point, Sudeep. What you're seeing right now is perhaps a very quick kind of a response. A lot of other reasons. You have this overhang of geopolitical conflict as well. But thank you for that, Sudeep Shah over there, talking about, where you have a long-term play on some of these counters. But talking about what you should do in the long term or mid to long term is Pratik Agarwal. He's ED Motilal Oswal AMC. Pratik, very good morning to you. And great to have you on the show this morning, where we're trying to figure out what is spooking the markets right now. Do you figure it's the geopolitical conflict, and will that pain then sustain?
So multiple things. One, bond yields moved up, 4.5 in the West, so higher for longer is there. Two, of course, higher oil prices, which were there even before the escalation of the conflict, and yes, the conflict. So now the thought is that a lot of these will probably be a dampener on any expectation of foreign inflows. Is that a negative? To some extent, maybe yes, but it does give the domestics who have been putting money in a structural manner in the market a lot of room to come in. Now, in terms of the resilience of the economy to sustain, higher oil and maybe some amount of export difficulties. When we say export difficulties, it is also import difficulties. Even ex of oil. So, if we look at, we have been bumping up our forex reserves. Current account last reading was pretty good. So, in terms of ability to sustain this flare up in oil prices, I think at this juncture we are very, very able to do that. Don't expect fuel pump prices to move up. We didn't see any decline when oil fell, and so on. So the impact on the economy also in the near term may be muted. Well, of course, macros and outlook do take a hit. Now the point is, if this stays, limited, then the impact is also limited. But if it really scales up, and oil, let's say, moves up beyond 100 and so on, then I think we have a larger reason to worry. But 90, 95 oil, I think, is something which is sustainable for a period of 1 to 2 months.
Pratik, morning, Niraj here. So, net Pratik, a confluence of a lot of events, does that make you believe that volatility could be higher and therefore maybe sit on a bit of cash or sit on the sidelines till it passes? Because a lot of it is unpredictable, to be honest.
Yeah. So for us asset managers, sitting on cash is a source of risk. We don't do that. Our funds stay broadly fully invested. It is up to the client to use the opportunity and put money in or stay in cash. So that is in the realm of their advisors. Given the long period structural growth story that India offers, I keep saying this, every dip is good. And investors should look at every dip to come into the market, which is a structural growth story like India, domestic and offshore.
Mm-hmm. Okay, from a fund manager's perspective, agreeable. Pratik, the last few days, some of the calls that I've made to insti dealing rooms seem to suggest that there is institutional money getting into metals. The PMI uptick that we're seeing, all of that leading people to believe that there could be a fundamental case to buy into metals, not from a short-term trade perspective just. What's your sense on metals?
No, so commodity has its days. This period could be one such period. China reflation and all of that provide some tailwinds to the same thought. We as a house, want to be focused on what we do best, which is high quality, high growth investing with outlook which go deeper into the future 3 to 5 years. And there, if you look at commodities, the volume expansion story there would be more like the economy plus minus 1 or 2 percentage points. So in metals, the big call becomes what happens to the margins and so on. We try and play it easier and go for stronger volume growth stories. So metals is something which as a house we generally give a pass.
Okay. Okay, Pratik, the other aspect is what happens to end users of commodities. I heard you say that oil base case couple of months could be 1995. Post that, and I agree, it could be unpredictable as well. Commodities, I just heard your answer as well. What happens to end users of commodities? Typically, a lot of people say that commodity price upticks tend to be, I mean, of course, tend to be margin negative, but also tend to be sentiment negative for the markets. Is that something that you would think as well?
Yeah, no, so that's correct. If you look at our market, the users of commodity and producers of commodity both may have similar profit pools, except that when producers of commodity make more profit, that profit gets a lower multiple versus users of commodity, and that results in overall market multiples going down. That happens, yes.
Okay. And Pratik, my final question really. I can understand for a fund manager sitting on cash is a risk as well. But elevated valuations, geopolitical stress, higher commodity prices, if all of this technically should not point to a very large uptick, then as tactically, if you had the choice, would you take a cash call? Sorry, I'm pushing you into doing something that you may not normally do in your profile of work, but I'm just trying to understand. If you can give me this answer. Okay, if you can't.
No, sure. So, we see our job as producing outperformance versus an index over a period of time, right? And just to understand, in that kind of a deliverable, if you take cash call, it is a risk. However, if a client, is okay to, and they should be okay to let go of a few percentage points of market action, saying that I want to sleep well, I think that is perfectly okay. But that said, anytime, you look at evidence of even investors taking out money, looking at a particular event, the event comes and passes, the same investor is able to come back into the market at a level which actually has not made him money. It happened during COVID. It happens practically every time, because the decision to take cash call happens after a particular dip in the market, and similarly, the decision to come back into the market would happen after the market has moved up a bit. Net all, the investor doesn't benefit from taking that call. 99% to my mind.
Pratik, in terms of the big factors that we'll be seeing in the next couple of weeks, or I would say the month or so, on the one hand, you have corporate results, you will have election sort of buzz coming in as well, and we identified some of the companies that could benefit if you have a third term of the same government, policy continuity, etc. Are these some of the themes that you're exploring right now, or is this more just conversational?
No, so if you're building growth portfolios, if you have policy tailwinds to the companies that you want to look at, it definitely helps.
Okay, and if we get more specific, what among these do you like? So, for example, if you have a very clear focus on things like affordable housing, infrastructure push, bullet trains, metro, do you see these as pipe dreams or something which will definitely be implemented, and then you will see that entire space coming up?
No, we strongly believe in the future of the country. Pipes will be required to fulfill all dreams. So Jal mission is also there. We are very positive on the outlook of the country. Okay? But where we are focused on is, let's say, luxury consumption as one theme, defense, yes, manufacturing, new age tech. So, you get the flow. All of these spaces are expected to do growth rates which are significantly higher than what an index may deliver and deep into the future. And there are, of course, more.
Okay. Prateek, just one last question, really. So much happening in pockets that are not quite comprehensible right now. I mean, so Morgan Stanley note on Excite today, for example, takes a stock higher. But we don't know what's the kind of uptick that, or a blue sky scenario that could come in for an EV battery company, or for a green energy company, or for something in AI. Have you pieced some thoughts around that piece? I mean, what is it that from amongst the futuristic themes do you pencil in as the one having the best runway for growth?
No, so, okay, our thought is there was a time when India used to be follower of technology trends. People made a virtue out of it. That if you adopt a technology trend 2-3 years into it, look at telecom when 2G, 3G, 4G happened in the country. It would lag the West, but now increasingly we are with the world. In some spaces we are ahead of the world. So very different kind of moves we see, and there are thoughts which are global. For example, there is pollution that happens. There is security angle as well. So EVs will succeed, maybe EVs stroke hybrids. Similarly, renewable power will succeed. I mean, there are no choices here. It has to. And the way to then go about doing things, when the market is just opening up, for example, in EMS, is to probably back guys, who have fire in the belly and would run and grab those opportunities. It does not happen too often that, there are opportunities and the government comes and says, you run, you do it, we will fund, 50% of it, as is happening in some spaces, and the state government comes and says, we'll fund another 25% of it. So this is when, this is built for entrepreneurs kind of a situation. And the whole idea is to find the best of them and build portfolios around them.
Absolutely. The growth story definitely stays intact. We're having a rough day. Is it an opportunity? That, of course, remains to be seen. Perhaps a bit of nervousness in the market today. Prateek, thank you so much for speaking with us. Always a pleasure to talk to you. We'll take a very short break. Now, one of the factors that the market is watching very, very closely, geopolitics, of course, is on, corporate results, etc., is also the upcoming results. And this is the season for pre-poll surveys. Now, Lokniti CSDS does a very credible pre-poll survey. They have some interesting extrapolations out for what kind of a vote share we could see for the various political blocs. CSDS's Sanjay Kumar joins us after the break to chat on some of that data. Stay tuned. back. You're watching India Market Open. Okay, politics is in the air. The first votes for the 2024 general elections will be cast at the end of this week. Polling begins on the 19th. Ahead of that, it's pre-poll season, and Lokniti CSDS has come out with its latest pre-poll survey. Sanjay Kumar, Professor CSDS, joins us for more perspective on that. Sanjay, great to have you on NDTV Profit and speak with you on some of this data. Now, let me start with what really caught my eye, is the data you put out on projections for vote share. And I'll just pull that up very quickly. You're saying Congress 21%, Congress allies 13%, BJP 40% on its own, BJP allies 6%. So you're looking at a potential NDA 46% vote share. What does that convert into seats? And if I compare it with the last election in 2019, that's a huge jump up, isn't it? That was about 37, 38% for the NDA.
No, it was 37.
All right, Sanjay Kumar has frozen there. We'll try and get him back in just a second. But Niraj, just to take you through some of that data and why we wanted to have that conversation with Sanjay today. Look at what you're seeing on our video wall as well right now. When you're looking at BJP vote share estimates, north and west, pretty much the same. Huge jump up in the south. You're seeing a possible increase in BJP vote shares in the southern part of the country, always a weak spot for the National Party, going up from 18 to 25%. That might explain why the Prime Minister has been spending so much time in Tamil Nadu and why that becomes an important battleground as well. In the east and northeast, of course, there is a focus there. But remember, West Bengal is another bastion that the BJP needs to sort of demolish. If you want to see a vote share bump up there from 34 to 42%, that looks good as well.
But the interesting thing is this, Tamanna, that I'm also seeing this Congress plus vote share moving up.
Yes, so what's happening is a consolidation on the two sides, where a lot of regional parties, so then the question comes that the India alliance, is that essentially advantage Congress at the end of the day? And there's just one more chart we should pull up to reiterate that point. And CSDS also did, favorites for who should be the next Prime Minister. So Narendra Modi gets 48%. Rahul Gandhi gets 27%. Look at all the other wannabe Prime Ministerial candidates. They're all at 3%. Arvind Kejriwal, Mamata Banerjee, Akhilesh Yadav is all at 3%.
I wonder if they obviously will not. Nobody will. But I just wonder if the other prime ministerial candidates, post whenever PM Modi is not the PM, would be favorites from the NDA cadre as opposed to the other parties.
I mean, itna long term is a little difficult to predict. But this is the latest. Sanjay, can you hear us?
Yes, I can hear you.
All right, checking if you're back on. All right, so we wanted to compare the vote share projections. You're saying 46% for an NDA is a significant bump up, isn't it? Compared to 2019, what does it translate into seats?
Tamanna, it's not easy to translate vote into seat because similar vote percentage can give you different kind of seats. And that is why we don't try to do that. But roughly you can imagine that if the votes are going up, because compared to 2019, so BJP is at least comfortably placed with the similar kind of a victory as they registered in 2019. At least safely we could say that this kind of a vote share should translate into BJP getting slightly bigger victory compared to 2019.
No, you don't want to put that figure, but right now it's about 300, 400 ke par. And I know you're not comfortable doing this whole game, which a lot of pollsters do.
But Tamanna,
this 46% puts it in that region.
Certainly not 400, but certainly above 300.
The BJP alone?
No, not. BJP alone 300, and certainly BJP is not reaching with this vote share 370. Neither alliance would be getting 400, the NDA alliance.
Okay, so the 400 ke par might just be a political slogan. You could see up to 370. The other thing that I noticed, and correct me if I'm wrong, for the INC, and now of course there's no UPA, there's an India alliance right now. For the Congress also there seems to be an improvement, however marginally over 2019. And
Yes.
the conversation we were having, this India alliance and the way the votes and the political atmosphere is polarized, is that an advantage to consolidate the non-BJP vote for the Congress?
If the more the non-BJP votes get split, it is an advantage BJP. More the consolidation of anti-BJP vote, it goes to the advantage of India alliance. That's certainly the case.
Okay, I want to understand even the regions that we've talked about, and we'll just pull up those charts. Compared to 2019, you were seeing a significant uptick possibly for the BJP in the South.
Yes.
South and the East, considered tough markets or actually tough areas to crack for the BJP. What do you think is changing there? What is, what are your pollsters on the ground telling you, Sanjay?
No, it is very clear that in the West and the North, if you look at the 2019 vote share, BJP had got 48% vote. And there are many states where BJP has matched. Rajasthan, Madhya Pradesh, Jharkhand, Himachal, Uttarakhand. And there are a large number of states where BJP had a very large number of seats, had won large number of seats and with a very decent vote share. But it is in the South, BJP has been trailing because in South, BJP faces the challenge from the regional parties. The data clearly indicates that BJP is on the rise in the southern state, and it is not a surprise to me because if you look at Prime Minister Modi and BJP's effort, they are making a massive effort in the southern state. Tamil Nadu, Kerala, Andhra, Karnataka, they already have a presence. Telangana. So I think what the data suggests is that the efforts of BJP is giving them rewards. Whether this reward will get converted into seats or not, but in terms of vote share, it's clearly evident that in the southern state, BJP's vote share is going up. Even in the East, and in the East, my own sense is that Odisha could bring a big surprise because this is clubbed East and Northeast. Assam, they are already in a very good position. They may better their situation. Maybe slight rise even in West Bengal. So that is what accounts for BJP or NDA's growth in South and the East.
We're also talking about a political battle with the incumbent going in after 10 years in governance. And the traditional question is, are you seeing any anti-incumbency? Now, I know you've done a detailed pre-poll survey and you've been putting out snippets of it over the last few days. Are you seeing any signs of anti-incumbency at all?
No, there's no sign of anti-incumbency. We ask a question, and it's a very straightforward question. Do you want this government to be re-elected or you don't want this government to be re-elected? And a very large number of people, though there is slight dip compared to 2019. In 2019, 47% people wanted this government to be re-elected. Now, in the current survey, the latest one, 44% want this government to be re-elected. But still, the gap between those who don't want this government to be re-elected still remains very wide. 35% people want this government not to be re-elected. So it's a 9-10% gap between those who want this government to be re-elected and those who don't want this government to be re-elected. Clearly on various parameters. Yes, there are anxieties about price rise, unemployment, and a little bit on corruption. But if we look at the other parameter, the government is getting a thumbs up. So Prime Minister Modi remains very, very popular. Overall government performance has been endorsed by the people. So I don't get any sign of anti-incumbency based on the data which we have collected recently.
No real signs of anti-incumbency based on the data. And remember, here at NDTV Profit, when we're covering elections, we're trying to do this data-based and backed by, what researchers have actually found. That's why, Sanjay, I'm glad that you're here with us today. I just want to pull up that chart once again on favorites for Prime Minister. And this is something we were talking about as well. So, no surprises that Prime Minister Modi has a 48% favorability. But the yawning gap between candidate number 2, Rahul Gandhi, and then Kejriwal, Mamta Banerjee, Akhilesh Yadav, what is that telling you in a political landscape where it's become more and more about the personalities? It's a presidential style election campaign at the end of the day for a parliamentary democracy.
I don't even see this as a presidential form of election. I see this as a referendum on one person, which is Prime Minister Narendra Modi. It's a referendum. If you want this man to be re-elected, if you want this man to continue as the Prime Minister, all those will vote in favor of BJP. They won't even look at their anxieties with regard to unemployment and price rise. And the voters who don't want this Narendra Modi to continue as the next Prime Minister, they would vote against Narendra Modi. So it is a referendum on Narendra Modi. Other issues we will keep discussing. This does come up when you do a survey, when you talk to the people on the ground. But finally, I think on the day of voting, the big issue which is going to matter in deciding who people are going to vote for is the person in the middle, Narendra Modi. People, whether you want this man to continue as the Prime Minister or you don't want Narendra Modi to be continuing as the Prime Minister. So it is a referendum. I don't even see it as a presidential election. It is a referendum now on Narendra Modi's government.
Just your take, Sanjay, on the BJP manifesto, which was put out over the weekend, and we put together some of the top 10 takeaways. A lot of focus on continuity rather than change, because it's been pitched also as Modi ki guarantee, that we've already done this work and then we will continue more in the same vein. Any surprises, anything different that you spotted?
So surprises in a sense, I think the manifesto gives us a sense of how well BJP seems to be connected with people on the ground, with the big architecture. The manifesto talks about 2 or 3 very big things: UCC, one nation, one election. But at the same time, look at various in minor details when it is talking about paying attention to the farmers. So it talks about those people who are engaged in like production of fruits and vegetables, those farmers who are engaged in fisheries, etc. So overall, I think it gives me a sense that it is very well designed document, and the way it was being presented it was not a press conference, but the way it was being delivered to the people through a 40-minute speech by Prime Minister Modi. So nothing new in a sense, but the new way in which it is being presented. You would have noticed that when the manifesto was released, 4 or 5 people were invited on the stage. These were common people who it was told that these are the people who have benefited from the government schemes in the past. So a very new way of presenting the manifesto in front of the people. And this also helps BJP in making a connect with the people of this country.
All right. So that's how it all stacks up as of now. Sanjay Kumar, thank you so much for joining us, of Professor CSDS. And, Niraj, they put this very, very detailed pre-poll survey out. Of course, pollsters are popular and in demand at this time. But this is one agency which talks only about vote share, which is actually the key metric. Seats finally determine it, but those seat projections you see sometimes are a bit of voodoo. It's the vote share that counts, and this points to a very strong vote share. Maybe not 400 ke par, but definitely a 370 kind of a scenario for the NDA if these numbers stack up.
Could be interesting times, and we'll keep an eye out for that. Take a break though. Some interesting brokerage notes on the other side of the break maybe, or okay, just before we take that break, let's just take one small deviation and try and look at what is interesting from a market's perspective as well, because remember, we're down about 1% now for the Nifty and the Sensex. So while we started off about 0.7, 0.8%, we're quickly down to 1% and kind of staying there. Some stocks though are doing well. Puneet had joined us to speak about the Morgan Stanley view on Excite. That stock is amongst the top gainers on the BSE 500. Let's just revisit that story. Puneet, thanks for joining us again, but just the stock movement compels us to talk about this more. Tell us a bit about this.
Yeah, thanks for that, Niraj. So the stock also hit an intraday high of roughly 6% today, and this is on back of a Morgan Stanley note which has reiterated their view of overweight on the stock with a target price of roughly 485 rupees per share, which is roughly at 22% upside from the start of trade today. Now they say that the company has an early mover advantage in the EV battery space, and they say that the share price could rise significantly over the next 10 years for the stock. They see that the addressable market to increase to roughly $13 billion for the industry, while they see that the partnership with Hyundai signifies and validates the technology and the investments of over 2,000 crores that the company has done over the past 2 years. Finally, on valuation, they have said that the current target price of roughly 485 is at 1.4 times price to book versus roughly 3 times, which is given to global peers. While during the scale-up phases, then generally a higher valuation is given to these battery stocks of roughly 4 to 6 times. They see that could roughly imply the stock could double from these current levels, and they also see that on a bull case they see an 88% upside for the stock at roughly 6 times price to book. So this brokerage has really reaffirmed Exide's investments and is a very, very positive view on the stock, and as you rightly said, the top gainer today in the auto space. Back to you.
Amongst the top gainers on BSE 500 as well, Aster being the first one. But has Sun Pharma recovered a little bit at all or no? Well, that's the question. One is what the stock does, and well, marginally off from the lows of the day. But Varsha Johnson to give us the details of the HSBC note on the stock after the US FDA action that has been taken. Varsha, good morning.
Good morning, Niraj. So HSBC has retained buy on Sun Pharma with unchanged target price, which determines an upside potential of 16%. Now, US FDA has assigned a OAI status to Sun's Dadra plant following the plant inspection in December 2023. Now, OAI means that FDA found notable deviations from its prescribed GMP quality norms, and it may withhold approval of new products from Dadra until Sun fixes the issues. Now, Dadra's OAI status add to challenges for Sun's US generics business, given Halol, again, its largest plant in US generics, is already under the FDA import alert. Now, Dadra is a key plant for Sun, which contributes almost 18 to 20% of its US generic sales, excluding Taro, while there should be limited earning impact as per HSBC due to Dadra OAI, as it contributes less than 2% of Sun's consolidated revenue. Sun mainly depends on Revlimid for its US generic sales, but HSBC expects its near-term US generic sales to remain range-bound at $120 to $130 million a quarter on the lack of notable new launches. Also, HSBC is positive on the growth outlook for its specialty business and sees a healthy outlook for the same. And they expect global specialty sales to contribute 19% of its total revenue by FY26. And specialty sales and steady India formulation growth should more than offset the challenges in US generics. So this is all on Sun Pharma by HSBC.
Keep an eye out for that. Varsha, thanks for putting that into perspective. But on that note, with the mention of what the indices are doing, Nifty IT is doing okay, but the rest are down for sure, with the Nifty Bank leading the charge lower, 1.27% lower in trade for the Nifty Bank in trade. And suffice to say, it is the financials which have clearly taken it on the chin. So those are to be watched out for in trade. Not that the top 10 names have financials losers, to be honest. It's Tata Consumers, Tata Motors, etc. But from a weightage perspective, some of the financials must be piling on the list of losers. We wrap it up on this leg of India Markets Open. From Tamanna and me and the team that put this show together, thanks so much for watching. Up next is Talking Point. Vaibhav Sanghvi, CEO of ASK Hedge Solutions, joins us.